All right. Good morning. It is Monday, July the 31st, 2023. We hope you had a nice weekend. I had a really fun weekend. So I took a quick 48-hour trip up to Columbus, Ohio. I try to make it up every year for the Ohio State hockey alumni, right? So I played. It's been quite a few years now, but every summer, weekend there's an Ohio State hockey alumni golf event, right? So a little fundraiser they put on. Really fun to see old teammates and reconnect with some guys. So our group, myself, Tyson Strachan, who some of you know, he works with our firm, and then two of my other teammates from back in the day, Dave Barton and Matthew Beaudoin. So we shot 14 under, which that's a pretty good score. Scramble format, of course, 14 under. The problem is it's these younger guys that, a lot of them still playing hockey. And so the competition has been, we finished, I think, 6th place at 14 under. There's like 40 groups, but I think our group had the most fun, which that counts for something. So really fun weekend. All right, last week's economic data, unambiguously strong. Okay, just a strong week of data. GDP, last quarter's GDP, which was expected to decelerate, came in higher than expected, 2.4%. Again, it's a strong, resilient consumer. Durable goods came in higher than expected, 4.7%. As compared to the previous month. Earnings reports are largely continuing to come in at or above expectations, and we've been talking about it for a while now, but just the economic strength of 2023 has caught a lot of people off guard. Morgan Stanley's chief strategist just came out and simply said, I was wrong. He's been very bearish. Just said he's wrong. And this is why it's so hard to time markets. This also shows the danger in becoming overly tactical, okay? Because a lot of people have been sitting on the sidelines the entire year, and the market's had a decent year, okay? Which is why what we do in terms of planning retirements. Why we feel it's much more in your best interest to develop that plan, that strategy that gives your retirement the highest probability of success, and then once you have that target allocation, rebalance as needed, right, to keep you in line with your retirement plan. Okay, so not surprisingly with the strong economic data, and it was consensus going in, but Wednesday last week, the Federal Reserve hikes interest rates another quarter point, which was widely expected, but it wasn't just the front end of the curve. Okay, it could be, again, a lot of this unexpected data to the better than expected data, further out on the yield curve, rates going up as well, right? So remember, the Fed controls, the front end. Further out on the curve, it's more data driven. So yields higher, bond prices lower, exactly what you would expect in a week of strong economic data. This week, right, we'll get some employment figures. Kind of the one most people look forward to is going to be Friday, where we will receive the jobs number, right, the employment figure for the previous month. So we'll see. It's obviously jobs, the big one in terms of what the Fed is primarily concerned with, inflation and jobs. And so we'll see if the data remains resilient. Always interested to see what yields do, and markets now. We had discussed earlier how markets were pricing in a Fed cut this fall. Now it looks like the markets are pricing in not pricing in rate cuts until March of next year. Okay, so we'll see. It's so interesting, very interesting times for nerds like us to follow along, and so With that being said, we hope you have a wonderful week. Stay cool out there if you are in the Charleston area. Gosh, just warm this time of year. It's kind of what we sign up for. And we hope you have a great week. Thanks.